Today we're digging into an analysis report on energy fuels.
Mm.
It details their huge Q3 2025 revenue surge to $17.7 million
Yeah.
and argues that its zero debt financial fortress position is setting it up for the next big bull run.
It's a fascinating thesis, and the writer has definitely done the work on the headline numbers. It's solid.
Absolutely. And the report kicks off right away with that undeniable success.
That big revenue number.
Yeah, that massive year-over-year growth. I mean, it went from $4 million in Q3 2024 to $17.7 million just a year later.
A 340% jump. It's huge. It grabs your attention.
And the report frames it as this big strategic win, validating that whole strategy of holding inventory for higher prices.
Okay, it's a great number, but I think right here is our first big opportunity. The immediate source and sustainability of that $17.7 million. It should be better integrated into the long-term thesis.
I see where you're going. It's a fantastic historical number, but for a high-level report, you need to know if this is a one-time thing or if it's the new baseline.
Precisely. The weakness right now is that, the report says the success came from cashing in on inventory.
Right.
But it doesn't really break down how much of that $17.7 million was from selling off old, long-held inventory versus how much was from their current operational output.
And that distinction is everything.
It is.
White Mesa Mill can actually produce right now.
It's a total blind spot for anyone trying to model this out. You look at an explosion like this, and the first question you ask is the fuse still burning, or was that it?
But is that fair, though? I mean, if the company isn't releasing those exact figures, is the writer just supposed to speculate?
Not speculate, exactly. More like apply their analytical judgment to guide the reader.
Okay.
So the suggestion here is to really strengthen the analysis by segmenting the revenue based on its origin. Give an estimate. Is it mostly current production, uranium and rare earths?
Or is it mostly inventory being sold off?
Exactly. Just establishing a clearer baseline for what this high-growth phase actually looks like going forward.
So you're moving the focus from, look what just happened, to, here's what this probably means for Q4 and into next year.
Yes, and you can do that with concrete examples to manage expectations and to really stress test the thesis.
Okay, like what?
Well, instead of just stating the big number, the writer could frame a hypothetical scenario, something like, if, for example, 70% of this revenue came from clearing old inventory, then our sustainable baseline is probably X. But
if 90% of it is new production, then the case is Y, and that's a whole different ballgame for future quarters.
Exactly. It shows you have command over the data, even when some of it is proprietary. You're guiding the reader, giving them a professional framework to think about it.
I like that. It turns the analysis from just a recap into a forward-looking tool.
That's the goal.
Okay, that's a powerful opportunity. Now, speaking of looking forward, all of this rests on what the report calls the financial fortress. And the writer does a great job here, detailing the $243 million in liquidity. That's almost $100 million in cash, the rest in securities, and zero debt.
In this sector, capital-intensive mining and energy, a zero-debt position with that kind of liquidity, it's extraordinarily rare.
It really is.
The report is right to position this as a huge competitive advantage. It's a war chest that lets them expand without diluting shareholders.
It's an undeniable strength, no question. But success, it often brings its own set of risks. If the financial risk is basically zero, what about operational risk? Is the view complete?
And that's the heart of the second critique. The assessment of risk should really encompass key non-financial operational exposures that are just inherent in being a strategic U.S. monopoly.
So the weakness is that by focusing so much on the zero debt structure, the report kind of creates this feeling of invulnerability.
Exactly. It overlooks the external risks that are tied directly to its America First market position.
Right, because this isn't just a commodity company.
Not at all. It's a strategic national asset. They operate the White Mesa Mill, the only conventional uranium mill in the entire country.
So operational risk, political risk, regulatory risk, all of that is tied to that unique monopoly position.
Critical. If you're banking on U.S. government contracts and strategic policy, you are by definition exposed to the volatility of Washington, D.C.
It's dependency risk, the flip side of the incredible reward that position offers.
Yes, and not addressing it is a missed opportunity to make the analysis truly robust. So the suggestion is to bolster the report's credibility by introducing and then, preemptively addressing one or two of these big non-financial risks.
That shows the reader that the writer understands the entire landscape, not just the balance sheet. It elevates it from a financial summary to more of a strategic, almost geopolitical assessment.
That's it. And for concrete examples, the writer could add a specific, limited section on this. They could address potential regulatory pressure on white MISA, for instance, or what happens if there are delays in Department of Energy grants or stockpile purchases.
So how do you suggest they mitigate that in the report?
They can use the data they already have. They could add a section, maybe call it Mitigating Strategic Dependency Risk, and talk about how the company's diversified strategy, producing both uranium and rare earth elements, acts as a buffer.
Ah, so it shows they aren't betting the entire $240 million on a single government contract.
Precisely. You take a potential weakness, which is that dependency, and you show how diversification actually turns it into a documented strength. It makes the whole argument so much stronger. It really shows the analysis can stress test its own bullish case.
Okay, let's move to the core of the report's thesis then. Valuation. The writer highlights this big gap between the current price, which is around $15.60, and analyst targets that go all the way up to $28.
Right.
And they attribute this gap to the stock being oversold and just reacting to short-term noise.
And this is where I see the final, maybe most crucial opportunity. The report needs to more rigorously hypothesize and then dismantle the specific reasons behind that market skepticism. Noise is just not a good enough answer.
That makes sense. Calling a 40% valuation gap noise feels a little thin for a sophisticated analysis.
It does.
So the weakness is that the argument just points at the divergence between the price and the fundamentals without really engaging with what the market is actually pricing in.
Right. There's some anxiety there that's holding the stock price down, and the market always wants proof of sustainability. If the writer doesn't acknowledge what the bears are worried about, the whole bullish case feels incomplete.
So you're saying the market isn't just being irrational, it's pricing in risks that the report has glossed over.
I think that's a fair assumption. The suggestion is to strengthen the conclusion by explicitly framing the most likely bear arguments and then using the facts we already know, zero debt, strategic moat, that mill monopoly, to systematically rebut them.
I like that. So instead of just stating the bull case, the writer is actively getting into a debate with the bear case and winning it. It engages the reader's own skepticism.
It does. And a really actionable way to do this, a concrete example, would be to add a section structured around the question, so why isn't UUU $28 right now?
And then you knock down the arguments one by one.
You take the core bear arguments and you neutralize them with the company's own financial strength.
Can you give me an example of that neutralization?
Sure. Take a common concern, maybe the slowed timeline for full commercialization of the rare earth elements business. It's a valid worry for a growth story.
Okay.
The rebuttal is the financial fortress. You point out that the $240 million war chest guarantees they can fund that entire expansion without diluting shareholders or taking on expensive debt. That zero debt position specifically mitigates the slow timeline risk because their fate is in their own hands.
That is powerful. It makes the zero debt structure not just a fact on a page, but an active shield against future risk. You're turning the balance sheet into a direct counter-argument to market anxiety.
It transforms the analysis from, this stock is cheap, to this stock is irrationally pricing in risks X, Y, and Z, and here is exactly why those risks are overblown given the company's unique position. That level of sophistication is what really makes an impact.
This has been a huge step forward for this analysis. I mean, the foundational data is there, it's strong, but